The $9.7 billion handover. This week, Microsoft formally accepted delivery of a 50-megawatt liquid-cooled data center in Texas from a former Bitcoin miner, unlocking a $9.7 billion cloud services contract. The company, IREN, is rapidly pivoting its operations from crypto to artificial intelligence infrastructure. Microsoft is so desperate for capacity that they agreed to a 20% prepayment structure, fronting roughly $1.9 billion just to secure access to these facilities as they scale up to 200 megawatts. But Microsoft is not handing over nearly $10 billion because they admire a crypto company's server management skills. They are paying a massive premium to bypass the single greatest constraint in the tech industry today: the infrastructure arbitrage. That constraint is the severe power and cooling bottleneck strangling artificial intelligence expansion. Skeptics argue that former crypto miners lack enterprise cloud experience and face immense execution risk. But hyperscalers have effectively unlimited capital, and energizing a new data center campus from scratch takes 5 to 7 years due to grid interconnection delays. Bitcoin miners accidentally spent the last decade building the exact infrastructure AI needs today: approved high-density power connections, industrial liquid cooling, and massive energy capacities. At current market rates, dedicating a megawatt of power to AI hosting generates roughly $500,000 more in annual gross revenue than using that same megawatt to mine Bitcoin. By swapping out mining rigs for NVIDIA GPUs, these former crypto operators are capturing an 80% margin uplift, which exposes a massive mispricing in how Wall Street treats these assets. The signal under the noise. The real implication of Microsoft's massive prepayments and the resulting infrastructure arbitrage is that the artificial intelligence arms race is no longer a silicon problem. It is a commercial real estate problem. While retail investors were obsessing over the Bitcoin halving, these mining operators recognized they were sitting on the scarcest commodity in the modern economy: grid-connected, liquid-cooled power. For industry operators and institutional investors, the calculus has fundamentally changed. You cannot evaluate these companies based on their hash rate or treasury reserves anymore. They must be valued as high-density utility landlords who hold total pricing leverage over hyperscalers desperate to deploy compute. The entire neo-cloud model works because tech giants simply cannot wait half a decade for regulatory approval to plug into the grid. Watch the remaining pure-play Bitcoin miners closely. Those with energized substations and gigawatt development pipelines will either secure massive hyperscaler cloud buyouts or face hostile takeovers for their land and power rights before the end of 2026. Subscribe for more.